more on the impact of the tax bill. CBS News business analyst Jill Schlesinger joins me now. Jill, we just heard from Nancy Cortez about the family tax credit coming back in, or some version of it. What will this now mean for families?
Well, this is an expansion. That child tax credit goes from $1,000 to $2,000. But in a hat tip to Marco Rubio, what really was interesting about this is that we now have a refundable credit of up to $1,400. Here's what that means. If you don't have any tax that's due, if it's a non-refundable credit, you don't get it.
Right.
If it's refundable, you get it. So that's kind of cool. I don't owe any taxes. I'll still get $1,400 as a tax refund. That could mean a lot of money to especially a big family, of course, and it certainly means a lot to someone who's a middle-class taxpayer.
Yeah.
There's also a non-dependent tax credit, so we'll have to see how that fleshes out. I haven't read all 500 pages, but there is going to be some relief there.
So Marco Rubio gets some political points for this, presumably.
Yeah, I guess. I mean,
it's
absolutely. I think that he could, for sure. And it's consistent with what he's been saying, which is he's saying, look, we're cutting the corporate rate from 35 to 21%. If we're going to do that, if we're going to give this big permanent gift to American corporations, the least we can do is to give not even a permanent, a temporary gift to families. Because don't forget, many of the individual provisions actually sunset after 2025. They just go away back to where they are today.
I think a lot of Americans would agree with his position there on that one. Now let's talk about homeowners. What can they expect out of this tax bill?
Well, if you remember in the early iterations, there was some talk about not having deductibility of state and local taxes. And then the Senate plan came out and said, okay, you can't deduct your state and local taxes anymore, but you can deduct your property taxes up to $10,000. Under this new plan we have out of reconciliation, you have some choices as a homeowner. You can apply that $10,000 to state and local income taxes, property taxes, sales taxes. So there's a way for you to maybe apply it. This was a nod to some of the California lawmakers, because for them, the property tax wasn't as important as the state and local tax, and giving the flexibility will help some of the upper middle class folks who are in those states.
Absolutely. So what advice do you have for homeowners on things that they can do now before the end of the year?
I was on the phone with a bunch of CPAs over the last week, and they are gearing up for a very busy end of the year, and the certified financial planners as well. I'm going to tell you what they are contemplating, but I'm going to do it with a caveat. The contemplation is if you're going to lose some of these deductions next year, either because you're going to now be able to claim the standard deduction or because you're going to be capped or limited, you may want to try to prepay your taxes right now by the end of 2017. Now, it's got to go directly to the taxing authority. You can't mess around with this. And you really have to be careful, because the caveat is the move that you make to save next year's taxes could actually negatively impact you this year, meaning that you may fall into a trap of an alternative minimum tax, a whole separate tax system. It's very thorny. My advice, I'll put my certified financial planner hat on right now, and that is, you know what? If you're really thinking about a move, talk to a tax professional, talk to your CFP, because it may not make sense, and it really is very important not to make one of these irrevocable decisions right this minute that hurts you in the long run.
Now, what about for landlords and second home owners? Are there big changes to those tax?
Well, you know, the mortgage interest is going to be a really interesting part of this, because, again, the House plan was going to drop the limit for your mortgage interest deduction. So under the House plan, they said you can deduct mortgage interest up to $500,000 of a primary residence. Okay. The Senate plan said, let's keep it at $1 million. That's better. It's at $1 million now. We'll keep it at $1 million, but we won't let you do home loans. The new proposal looks like the limit will be $750,000, that you can deduct interest up to $750,000 on either your first home or a second home, not a rental property. It's very important. So if you have a vacation home or a second home, or you live in a couple places, this is very good for wealthier taxpayers who have big fat mortgages. You know, that's the reality. And the 750 number was, I guess, sort of splitting the difference between the two. again, this really does tilt a little bit towards wealthier taxpayers because obviously most Americans do not have
a second home
or have a mortgage that's more than $500,000.
Absolutely. Now, what would you say to the residents of certain blue states that feel like they're really getting screwed in this tax deal, and they perhaps wonder why their Republican congressman didn't fight a little harder for them?
Well, I guess what I would say is you're probably right. Or as your shrink might tell you, your feelings are your feelings. I'm going to tell you you're right. This is bad if you live in a blue state. The argument around this has been from the Republican side, it's not our fault you live in this state where they can't run their house, their fiscal house, a little bit more conservatively. It's your fault that you live in this high-tax state. Now, you look at a lot of the state where they can't run their house, their fiscal house, a little bit more conservatively. It's your fault that you live in this high-tax state. Now, you look at a lot of the congressional leaders from both California, casting aspersions at us and how we run our state. The federal government does just very well. I think the problem is that you just simply were fighting a losing battle. So it looked to me at the end of the day that once the Senate plan went through, these House Republicans just didn't have the leverage. What was their leverage? They couldn't come together. I guess if they all had banded together, maybe they could have done it. But this is a rough one.
Yeah.
And,
a group of blue state Republicans could have made some change.
I guess. But, look, they got the 10,000 because it was going to be eliminated.
Right.
If you really want to know, if you talk to a tax purist and they say, how do we really change the code so it becomes fair? The way to do it is to eliminate every single deduction. And then you don't feel like any one person, state, place, type is singled out.
Yeah.
And the problem is that means goodbye to your mortgage interest deduction totally, goodbye to everything else, goodbye to your charitable. But the people I talk to, tax policy people, they say that's actually the smartest way to do tax real reform because, again, you don't feel like you're singling anyone out.
Right. All right. Jill Schlesinger, thank you so much for all that.
Sure.